Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending November 19th, 2021. I'm Preston Brent. Thanks for tuning in. Well, normally you hear the term two steps up, one step down, two steps up, one step down, on and we go. Buy the dip, let's go higher. Well, where are we in that process? Are we at the top of the stairs, in the middle, or the bottom? Two steps up, how many down? I still think, as I've told you guys before, we've got a little bit more that we can go to the upside. Before we get into any of that, let's take a look at where we've been for this past week. Let's take a look at the indexes, and we'll start off with the U.S. performance. Um, if you look at it, it was kind of a mixed week, right? The Dow and the Russell were down for the week, Russell being down the most. Year to date, everybody's comfortably in double digits. The valuations are still relatively high, but not crazy high. The forward PE ratio of the estimated earnings over the next 12 months is at 22.43. You can see the dividend yield in the U.S. finished the week in the S&P rather. Finished the week at 1.28%. Treasury yield came in at 153. So Treasury still higher by 25 bips. That's not very much, folks. So it's still going to channel money in the S&P. You can see the earnings yield in the S&P is at about 4.36%. So it is higher than the Treasury by 2.83%. So still, it's going to force money into the equity markets. And because inflation is so high, the real yield is a minus. We're in the negative territory. So money is in search of yield and returns, and we're finding that in the S&P. That's where we are right now. You can see the current VIX closed out the week actually almost 10% higher than the prior week. Even though it was a mixed week, you can see the VIX closed out the week at just slightly under 18. The best performing sector for the week was discretionary, which shows more growth than anything else. The worst was energy. It came in worse than that. It was down about 5% for the week. You can see year to date, though, energy was up 49% year to date, almost through the end of the year. Staples bringing up the rear, but still in the green at 8.74%. Um, and if we look at the indexes, you can see here, and we look at some of the performance levels. Let's just take a look at the economic data that came out. Retail sales we see is up 1.7% for the month of October, this last month. That's the biggest gain since March of this year. September's increase was revised higher. Now, inflation is kind of behind some of the increase because things just cost more money. Gas station sales, for instance, rose just almost 4%. Holiday shopping appeared to be hard at work as well. Industrial production in October also rose more than expected, 1.6% versus the 70 basis point estimate. Manufacturing activity also came in well above expectations as well. But we're also seeing a sharp rise in inflation, and we saw the U.S. consumer willing to spend. I mean, they're just pumping money into the economy. I think a lot of them are front loading their spending in anticipation of higher prices yet to come. You were seeing a sharp rise in inflation. We're seeing a number of things across the board. Retail sales, as I said, up 1.7% in October. Retail sales is up 16% for the year. Okay. So we're getting a lot of increase in consumer spending, which is a big part of the US GDP. Although we did see consumer sentiment, which typically leads the market a good deal, okay, falling to a decade low. So keep that in mind. All right. It typically leads the market performance by about 4 to 6 months. So that would suggest next year, as we go into Q2, Q3 in the summertime of next year, based on consumer sentiment reading now, it's not going to be nearly the kind of returns we're getting right now. Okay. Now, if we look at U.S. Treasuries, all right, where's the interest rates? Well, Treasury yields pretty much were little change for the week. Okay. They decreased a little bit Friday when we saw Europe starting to shut down more, like Austria and Germany and other countries across Europe are beginning to implement more lockdowns. I don't think these knuckleheads realize that lockdowns don't really work, but that's what they're doing anyway. I just think it's a fool's errand in my mind, in my humble opinion. The other thing that the markets are out watching for from the U.S. Treasury perspective is who's going to be the next Fed chair. Right now, as you guys know, it's Federal Reserve Chairman Jerome Power Ranger Boom Boom Powell, as we like to call him. I think he's been fair, a little bit dovish, but not as dovish as some of the other rumor of Governor Lael Brenner. She is viewed as the most dovish, and it's right now it's probably a 55-45, 55 leaning towards the current chair, Boom Boom Powell, and 45% to Brainerd. So we'll see how this thing plays itself out. Sippy Cup Joe's under a lot of pressure to appoint a very progressive person, but I think what he may do is leave Boom Boom Powell in place, and that'll give him. He's still got a couple more that he can put on there. I think there's a couple more dues, so that'll give him a little bit more latitude to put some real progressives into the Fed, right, into the governor spot. So we'll see how that plays itself out. All right. Keep in mind that some of the Fed voting members are talking about at this next Fed meeting in December of increasing the tapering amount. Right now, they're doing a quantitative tightening of 15 billion in November this month and 15 billion next month in December. And if you've noticed, they didn't put any stipulation on what they're going to do in January. So that leaves the room open for them to increase the January quantitative tightening, that of which I think they will, either 20 to 25 billion. Because even though they're taking money off the markets, they're just taking off what they're already putting in. So given the current structure, they're going to put another 400 plus billion into the Fed balance sheet between now and when they wind down all of the tapering. So I think they need to do it a lot faster. The other thing the markets are starting to price in is a rate increase next year due to some components of inflation being more sticky than others. Right. So I think going through the end of the year, and I'll show you the charts here in a minute, I think we still have some more grinding higher mode to do, but I think it's going to be a completely different story in 2022. Okay. Of course, across in Europe, as I mentioned, there are more stricter restrictions coming in place, stay-at-home orders, movement controls, all of this in their mind to curb the spread of coronavirus. But COVID, that has not worked. And these idiots never, ever learn. Okay, they just don't. So that is, that kind of put the kibosh on oil and energy this week. Also on interest rates coming down a little bit, because typically what happens in Europe kind of works its way over to our shores from the COVID perspective. But hopefully most of the governors in the U.S., at least the red states, the Republicans, are going to just not do this shutdown crap. And just realize that it's going to be, it's going to be like this every year, I guess. So we're also seeing inflation hitting the European markets as well, more so in the UK. They had their inflation come at the highest level in almost a decade this past month, reaching about 4.2%. And that was up from 3.1% in September. Of course, they're blaming it on higher energy costs and things like that. So we'll see how that shapes out. Now, of course, if we go over the Asian markets, well, let me just show you here how the markets fared. You can see the Euro stocks, the 50 largest companies in Europe, were down just slightly below zero. Year to date, everybody's solid in the green, double digits across Europe, right? The Euro stocks, the FTSE, the London Exchange, CAC 40, which is French, DAX for German, all of them double digit for the year, but kind of like the US, a little bit flat, a little bit of a mixed market. And of course, if we come over to the Asian markets and just see what's going on over there, China, it's just barely in the green on this particular index, but the main tracking Shanghai that includes more stocks, it's in the red for the year. Hang Seng is also in the red, the Hong Kong index, a little over 1% for the week, a little over 8% for year to date. Okay. So if we look at Japan for just 1 second, Nikkei seems to be good. They're in the green for the week. Year of the date, they're up 8%. Now, why is that? Well, money does strange things. Their newly elected Prime Minister, Fumio Kishida, and I mentioned this before, their government approved a larger than expected stimulus package, roughly about $500 billion US dollars. All right. And by carrying out that stimulus package with a sense of urgency, Kishida hopes to rebuild Japan's, very hard hit, COVID hit economy. And also they published their GDP numbers showing the economy shrank 80 basis points in Q3. It's one of the few that shrank. Okay. That's equal to an annualized contraction of 3%. So that their Japanese exports only rose 9.4%. While it sounds high, it's the slowest pace they've had since February this year. So given this outlook, the Bank of Japan Governor Kuruda, he emphasized the need to persistently continue powerful monetary easing. So a lot of easing still going on in Japan as it is across Europe. And then, of course, if we take a look at China, you can see um, they still have problems with debt. It's primarily in the real estate market. So it's not a surprise. Economic momentum stayed weak in October. Real estate market is down very heavy. Prices for new and resold homes fell amid deeper contraction in construction starts and investments. Housing sales also shrank over 21% in October. And it's just really 52 of the top 70 cities across China recorded month-over-month declines. Keep in mind the real estate market in China, because a lot of the Chinese don't put money into the markets. Only very few do for the very wealthy. Most of the Chinese put a lot of their money into their homes and real estate. So therefore, real estate is a big component of China's growth. And when real estate tanks, that's what we're seeing. And that's why China is just having such a hard go of it. And I'll show you the charts here in just 1 minute. Speaking of charts, why don't we just shift over? Let me just shift my screen over. I'm going to take you over. We'll start with the U.S. Take a look at the U.S. Here we go, right here. We'll go look at the U.S. E-mini S&P 500 futures. We'll start with them first. Let me just see here. Let's get this out here. As soon as it comes up on the screen, I'll show you guys where we're sitting. All right, so I'm showing you guys should be able to see this now. So you can see the E-mini S&P 500 futures back in October. It was down around 4260. Now remember, I had a projection right up here around 4600. I had said the market's going to go anywhere from 4500 to 4650 by the end of the year, and that was back as we were pulling back in September. I said we should get about a 5 to a 10% pullback. We got about a 5 or just slightly around a 6% pullback in September. And then off we went. That was my initial target. We blew right through it. We came up here, did a little bit of a pullback to my original target, and then we closed out the week at 4720, or we closed out the week at 4697. So 4700, once we blew through it, I said we're probably going to come back and test that level again. It's a very common thing to do when you blow through a number that is divisible by 100 in the S&P. All right, very common. And it's common to also hang out at that number for a little bit. As you can see, we did. You can see this is an Elliott wave 3. That means it's an impulse wave, which means it's a very strong wave up. You typically get profit taking on this, and a pullback of, anywhere from 2 to 4%, maybe 5% before you get another run higher, and then you have a blow off top, Elliott wave 5. Then you get a lot of divergences in the Elliott wave 5, indicator divergences like RSI and MACD. And once you get that, then you can expect the markets to kind of shift a little bit of a bias. But you can see here on this initial bend here, MACD was a lot stronger. So this could be, and the reason why is this is an Elliott wave 3, and even with this higher move here, you can see the the MACD is moving a little bit lower. That's normal. I'm expecting a pullback of about another 50 to 75 points before we grind higher again. Now, we can grind higher on any news. Remember, if Sippy Cup Joe appoints who is it, Boom Boom Powell, then the markets know him. The better the devil you know than the devil you don't know. So if he gets in, I think that'll be a sigh of relief for the markets. If we get in the other candidate, Lael Brainerd, she is an unknown. She's known to be a lot more dovish. So it's really hard to predict just what the market's going to do, okay? And typically when you get someone very dovish and the markets want to go higher, however, that could fuel inflation fears and a host of other issues as well. So we got to watch this very closely. But either way, I think it could move the markets when that announcement comes out. Okay. Now, if we look at an interesting chart I want to show you is the SPX cash index over the equal weight SPX. Now, look, we had a big breakout here on Friday, and you could see this big move higher up here. What does that mean? That means think of the S&P 500 stocks, each one of them having 1/500th of a share in the index. So each one is only attributable for 1/500th of a movement. Well, when this is moving up like this means the equal weight is losing, which means it's guided by the bigger stocks like Apple, which has got about a 4% weighting, and you add up Apple and Microsoft and Amazon and Facebook and Google, they account for like more than double-digit weighting, 10, 15, 20% weighting of just the S&P. It's over 45, 46% of Nasdaq. So when those guys are leading the way, you have this thing going higher. Okay. So that's kind of where we're sitting right now in this. And if we take a look at the FANG index, it's no surprise that we had an all-time high on Friday in the FANG index. Now, this index I've customized in eSignal. It has incorporated Microsoft, Facebook, Apple, Netflix, Google, and Amazon. So it's no surprise to me. It's kind of a FANG plus. It's not a pure FANG because I've thrown in a few others in here. But you can see here, these are mega cap, tech, or growth. And it's just through the roof. And you can see the MACD here, very little divergence at all, which means that any dip is probably still going to be bought, which leads me to believe that we can still have a nice run up through the end of the year. And of course, if we look at the Russell, it has more or less given up a lot of its gains right here. Remember, the Russell broke out small cap and then is pulling back. I think this is, and again, you can see the MACD, no divergence. Typical Elliott Wave 5 is a divergence in an Elliott Wave 5. So I only use Elliott Waves. My system generates them. I only use them as just a general idea to confirm or not confirm an overall trend bias. All right, and whether it's a major wave or an impulse wave or just a profit-taking dip. But in this case, because if we step it out, you can see the Russell has been nowhere for a long time. We had that breakout, and I said once we get that breakout, we will make new all-time highs. The last all-time high was back over here on March 15th, and we just came right back up. And I said we're probably going to retest that for sure. Notice the 50 EMA is sitting at the top of this boundary that has been in all year long. So I want to see if it can regain support at the 50 EMA. You can see right here where it held the 50 EMA. It came down, kissed it, and then just bounced hard back up. So this will be a little bit of a clue for us on where this thing wants to go. It'll probably come down a little bit further on this 50 EMA. I want to watch it and see what it does. Okay. Now, of course, if we look at the Dow, the Dow had a down day on Friday, primarily because Boeing and a few other large cap stocks got hit hard, and they tend to affect the Dow more than others. Okay, you can see my pullback. It hit my first pullback zone right here. The second one I got it a little over 35,000. Okay, so that would take us down another 400, 500 points to get to this second one. But we hit them. And these are just my pullback area. But now this is an Elliott Wave 5 also. But to me, I don't see a lot of divergence in this right here from over here. So I don't think we have too far on the downside to go, to be honest. This was my original target, about 36,000. We got up a little bit higher than that. I knew we were going to come back and retest that area. It's almost a given. And I was telling our members to fade this move up here. It'd be a pretty good easy picking, I think, or low-hanging fruit kind of trade. Anytime you blow up like this and blow through, when I'm seeing an Elliott Wave 5 count and I don't have significant issues in MACD or in the RSI, you can see with the RSI, I don't see a lot of significant issues here. In fact, it's actually higher than here. I'm not seeing that divergence. So that just tells me that fade that move should be an easy, comfortable trade. And that's what it was. If we look at the Dow transports, okay, you can see here where the Dow transports, again, let me get it back on the MACD for a second. we couldn't quite make new all-time highs, and it's pulling back as well, but still fairly strong. This reminds me of a cup and saucer, a cup and handle pattern where we have this rounded bottom and then up and then a little bit of a dip and then away we go again. If that happens, the typical measuring objective outside of this is about 10% rather above the previous high point right here. So that would put us up another 28 points, right? Up over 3010 area. So we just have to wait and see where we're going to spend our time and how this works. Now, looking at the other markets, if we look at the Vanguard All World Index, it's a lot weaker. Our last all-time high here was back in the summer, and then we're making lower highs as we go and lower lows. So that's a classic definition of moving lower. Now, it's a very wide range, so if I were to put this into a regression channel, the lines would be very wide, but either way, it's showing that we're going lower, okay? Now, keep in mind, if we look at EEM, emerging markets, it's going to show the same thing. In fact, with emerging markets, we're in the red for the year. You can see the closing price of last year is this blue dashed line. So we're in the red year to date. Keep in mind, emerging markets, about a third of this ETF, 33%, is made up of China's stocks. So that's why it's hurting. And of course, if we look at China, the measuring objective I like to use for China is Asher. Even though we moved up strong on Friday, you can see we're still in the red for the year, just like emerging markets. We went below in the red in the end of the summer of this year when China started getting ugly with education and tech stocks. It's just been ugly all around. Okay. So the markets aren't going to be relying on China too much right now. And then, of course, if we look at Bitcoin, you can see the pullback in Bitcoin. All right. This was an Elliott wave 3, so that's an impulse move higher. That would suggest we still have higher to go. You can see the MACD is higher than this point right here. You can see a little bit of a divergence here. So we did get a trigger on November 12th to take a short in Bitcoin, right? And then it came down, blew below the 50 EMA. Let me just blow it up so you guys with bad eyesight can see it. Let's just kind of zoom in on this thing. You can see we came below the 50 EMA, closed just above it, and then intraday we went below the 50 EMA, closed above it. You can see my fib nodes on here. I haven't even adjusted them. Let me just adjust them to give a more accurate picture to reflect the highs. So the highs in this thing were 69,355. So that'll make the change in the drop here. And I had said anywhere from 23.6 down to 38% pullback. That's a normal, actually the 38% is a normal Elliott wave 4 pullback. Okay. So we could actually go down to about 54,000. We closed at 57,830. So while that sounds like a lot, it's not that much in percentage terms. Get a little bit of a rebound and move higher. If we hold the 50 EMA and come back up over the 23.6% fib node, then we can go higher. You can see now when I blew it up, the divergence. That was the trigger of the trade right there. It actually had a slight up day, and then the minute we took out the low of the previous day, that would have been a short signal in Bitcoin. And this is kind of where we're sitting right now, okay, in this mode. If we come down and if we take a look at some of these other things that I'm following right here, like if we take a look at volatility, it actually moved up for the week, okay? You can see here, vol has been moving up going back to the 16th of November, 17, 18, 19. We're making higher highs in volatility, even though the markets in general were steady to going higher, okay? A little bit. So when you got a positive correlation between the VIX and the S&P 500, meaning they're both going in the same direction, generally volatility wins out. We are in the yellow zone right now in VIX, which tends to be a more choppy market. If I were to zoom out, you can see a little bit of a choppy market in the VIX right here. But if we go out to the back month, we're well in the green. So I'm not too concerned about that just right now. We'll see how this thing plays itself out. And of course, if we look at treasuries, let's go to the bond market. You can see interest rates, bonds were up. Ideally, I'd love to see bonds get up and challenge the 200 again. I'd be willing to put on a short. Just like I said here, you got to be short bonds up here. You want to be shorting bonds as it moves higher, okay? Because what happens is when they start raising the rates, you're going to see bonds. The only thing that's keeping bonds like this now is that the markets fear that economic growth over the next few years is going to be lower than people think. And the Feds are going to be more dovish than people think for longer than you think, regardless of where inflation goes. So there's a lot of cross currents going on in the bond market right now, which, basically translates into interest rates. And the 10-year is kind of the global risk-free rate. You can see the 10-year here is a little bit elevated from where we were back over here in the summer months. And I think it's going to stay elevated, but not as high as people think. My target into next year for the 10-year is up around 190. All right. So that's kind of where I think we're going to end up next year. Now, it could go higher if the Feds come out with some surprises, but that's where I think we're going. Keep in mind the 30-day Fed Fund futures is pricing in an interest rate hike in the summer months of 2022. The Feds aren't saying that. And I think the markets don't have a lot of that priced in, but if they do, I think we'll see a drop in the markets. A little bit of a revaluation in the equities, I guess, so to speak. We come down here and we look at currencies. Look at the dollar, man. Man, oh man, oh man. This thing is just a bear. Look at it. It's up near its 2021 high. A strong Friday. No divergences in the MACD. So the dollar is where you want to be. And it's no surprise the US economy is doing a lot stronger than everybody else. And the dollar, as I've said many times before, should be classified as the dollar index, because making up the dollar index is a basket of currencies. The euro is about 58%, The yen is a little over 13, pound is about 12%. And then you got other currencies in there making up less. But when you put all those currencies in, the dollar index moves based on how the components move. So typically just use the euro as a benchmark. If the euro is going higher, the dollar is going lower, or the dollar index is going lower and vice versa. But you can see here where the dollar is sitting right now. So that would suggest the euro is going lower, and lo and behold, the euro is hitting some real low lows. It's already below its closing price of 2019. I don't have the 2020 opening price in here, I don't think. Let me just come in here and see. Maybe I just mislabeled the thing. No, I did mislabel it. So look at the euro, though. I mean, this thing is just falling off the table. And look at the MACD. There are no divergences there. That suggests that this thing can go even lower. And closing down countries and closing down businesses across Europe is not going to help the euro at all. I mean, heck, we closed out the week at 1.12. Keep in mind, we were at 1.23 back over here in January of this year. All right. 1.23. That's amazing. You know how big that is, a big move in the currency market? Let me just measure it just to show you guys. Currencies don't typically move like this. So we're down right now, year to date, are off the highs of about almost 8.7% in the currency. That's huge. So anybody that's going on to Europe, this would be the time to do it. Your dollar is going to be worth a lot more, in most other countries as well. And then, of course, if we come down here and we look at metals and we look at gold, gold was down about 14 points in January. Longer term, I am bullish gold. All right, so don't get me wrong. But short term, gold is just it's being manipulated, it's being moved around. But I think longer term, it is going to go higher. A key level for gold to take out in my mind is that level right there, right around 1900. You can see the 1880, 1900, that whole zone. It's going to be very sticky in there, but once it blows out of there, it's going to hit 2000 pretty quick. Mark my words. And for those of you I've told this to, especially our members, silver is probably the better play longer term. Okay. Now you can see silver is just kind of a no man's game too, going all the way back to the summer months. It's having a hard time holding a bid. But I do believe over the next couple of years, silver also is going to be a lot higher. Okay, and then copper, one of our favorite metals, you can see here is very volatile. It's holding the 50 EMA. Longer term, I think copper will be up, but there are a couple of cross currents with copper also. There's two, one bullish and one bearish. The bearish cross current in copper is China. China is a big buyer of copper. When China does poorly economically, copper falters. But the other thing that's given it a boost is electric vehicles, EVs. Each EV uses about 40% more copper than does a gas-powered car, primarily due to the battery. So we're going to see here copper kind of chop like we've been. We've been in this chop mode going all the way back to this, in fact, for the entire year. Outside of this big run here, it's just been chop. And we may see that for a while, okay? A big chop range for copper. Longer term, I like it bullish, but again, things can change, especially with some of these metals. Energy and oil, well, if we look at oil, it's pulled back. It had an ugly week, and we broke right here. Remember, I told our members back over here, fade this move. I told our members up here, fade this move right here. Now, it is an Elliott wave 4. So a typical pullback, if I just let the system calculate it for me, I'll just put this right on here like this, and it'll calculate. The initial pullback should have been there. It's blown lower than that. And basically what happens is these circles get closer and closer together as we move forward in time. And that puts a price in the middle. This is a typical Elliott wave 4 pullback. And it's saying in the lower 70s. Could be as low as around 71.35. Okay. So I think once that momentum picks up, it can speed up to the downside. Once we get a signal, and members, I'll be talking to you about it, where it looks like it's going to consolidate, then we could move higher. But all of this shutting down in the fall time has spooked the oil market across Europe. Also afraid that could happen here in the U.S. as well. So we'll see how that plays itself out. Nat gas, you can see here, again, another win for some of our clients. I was telling our clients here and our members, fade these move higher. Caught the 50 EMA. I said, hold off, fade the move higher. And now we blew below the 50 EMA. I think if it regains the 50 EMA and we do have a cold winter, it's going to come up and take these highs out. We're going to look at possibly fading that move. That's kind of what I would want to do. Now we're getting some highs in other areas too, especially in the ag market and the meat market, some of the softs. So members, we'll kind of review these as opportunities come up because we're going to be very opportunistic in the commodity market. Otherwise, everybody have a great weekend. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. I'm seeing options are getting bigger and bigger in the market right now. If you don't understand them, then you're just going to get crushed. Okay. All right. Have a great weekend, everybody. Members, I'll see you tomorrow evening for our weekly market watch. Take care, folks. Ciao.